Hello, today we are going to the second chapter of Advanced Financial Management. Chapter 2, Financial Planning and Short-Term Finance. So this chapter has four objectives. At the end of this chapter, you should be able to define what working capital means, the components and types, understand the need for working capital and the effect of increase or decrease in the current asset and the current liabilities on profitability and risk, explain working capital financing approach, and elevate working capital management and its techniques. This also about the objective of this chapter. So when come to what is working capital, working capital is the current asset that changes from one form to another within a normal business process. So when count it is a type of working capitals, gross working capitals, and net working capital. When we say the gross working capitals, the total current assets of the company. Net working capital means it's the difference between current asset and current liability. Net working capitals can be positive or negative. When we say the net working capitals can be positive, the current asset exceeding that current liability, whereas the net working capitals can be negative, the current asset is less than to current liability. So when count it is a components of working capital constitutes various current assets. See, cash in hand, cash at bank, marketable liquid securities, bill receivable, short-term loans, inventories, prepaid expense, accrued income. So these all are the current asset. When counted is a components of current liabilities, account payables, bill payables, outstanding expense, short-term loans, dividend payables, bank overdraft, tax payable, so and on. These all are the components of current liabilities. So, types of working capital based on times. Working capitals can be classified into permanent and temporary. Permanent working capital is refers to the minimum amounts of the current asset that should be maintained at all times. The level of the permanent current asset depends upon the nature of the business. So when count it is a temporary, it is the amount of current asset which is required to meet the seasonal demand, like to holidays. So when count it is the need for working capitals for purchasing of raw materials and spares, payments of wage and salaries, day-to-day expenses. A business concern has to maintain working capital to make payments for various expenses on daily basis like fuel, power, office expense, etc. For this purpose, the working capitals are very important. Relative cash outflows to make the payment for current liability, cash inflow from conversions of the current asset to more liquid form cash is difficult to predict. Therefore, it is necessary to maintain adequate amounts of working capital to make payments for obligations when they become due. When the more predictable the firm cash inflows, the less working capital a firm needs. So we come to the other subjective, the trade-off between profitability and risk. What is profitability? Profitability is the relationship between revenue and cost and expense generated by using of the firm assets. So the firm can get the profit when the revenue is exceeding that the costs and expense. So when come to the risk is uncertain outcome. In this context is the probability that a firm will unable to pay its bill when they become due, the risk of technical insolvency. The greater the firm of the net working capital, the lower is the risk. Trade-off between profitability and risk. Changes in current asset. Increase or decrease in current asset has the effect on profitability and a risk of insolvency. When the current asset increase, both the profitability and the risk of insolvency decreases. The reverse is true when the current asset decreases. Increasing current asset means tying up of the firm working capitals in a way that it does not produce return. When to increasing of the current asset, increasing of the liquidity and decreasing of the risk and the profitability. Changes in current liability. Increasing current liability, increase profitability. Between the current liabilities are less expensive source of financing, no interest or charges. Increasing current liability, increase risk of insolvency because increasing of the current liability, it's decreasing of the net working capitals. So it is the result of what? Unable to pay obligations. Thus, it means trade-off between profitability and risk by maintaining appropriate mix of current asset and current liabilities. Working capital financing techniques. A firm can adopt various mix of the following three types of current financing policy: long-term financing, short-term financing. So in count it is a long-term financing, common and preferred stock, long-term borrowing, retained earning, bond issues. So these also can be get under the long-term financing. So in count it is short-term financing, financing obtained for a period less than 1 year. Short-term bank loans, commercial paper, factories of account receivables, and on. A spontaneous financing. What is a spontaneous financing? Automatic source of short-term financing arises in the normal course of business. Example, trade credit from supplier, outstanding expense, or the accrued liability. A firm is expected to utilize this source to the fullest extent as it has no explicit cost. After spontaneous financing sources are fully utilized, the choice of financing is between short and long-term financing sources. Working capitals financing techniques. So in count years, depending upon the mix of short and long-term source of financing, current assets, the approaches can be matching approach, aggressive approach, and conservative approach. So in general, there are three working capital approach. Most business experiences seasonal or cyclic fluctuations of operations. Example, construction firm have peak during dry seasons. Retailers have peak during Christmas. Seasonal working capital should be maintained to meet the demand of seasonal peaks. However, current assets rarely drop to zero. This fact leads to the maintenance of the permanent current asset. Permanent current asset equals to permanent fund requirement minus the fixed asset. So when we get the permanent current asset, the difference between the permanent fund requirement is minus the fixed asset. So we can calculate the seasonal fund requirement equals to total current asset minus permanent current asset, or current asset minus permanent fund requirement minus the fixed asset. Because as I mentioned from the previous discussions, permanent current asset means permanent fund requirement minus fixed asset. Look this table. For instance, the first row, the months, the second is the current asset, the third row I mean, the third column is the fixed asset, and the fourth column is the total asset. So total asset, we can get the sum of current asset and fixed asset. 1 plus 2 is refers to the total asset. The fifth, permanent fund requirement is, so seasonal fund requirement is the last column. So how to determining of this the seasonal fund requirement? It is the sum of what? The total asset minus the permanent fund requirement. By this formula, we can get seasonal fund requirement. For examples, when come to it in January, the current asset is 50,000, the fixed asset is 7,000. It is the sum or the total asset is 12,000. Permanent fund requirement is during January 10,000. So seasonal fund requirement is in January it is 2,000 because of 12,000 minus 10,000. So by using of this formula, we can get seasonal fund requirement. Working capital finance techniques. So income it is a matching approach. This matching approach it is sometimes known as hedging approach. Involves matching the expected life asset with the expected life of fund raised to finance the asset. Example: a 10 years loan may be raised to finance a plant with an expected life of 10 years. A stock of goods to be sold in 30 days may be financed with a commercial paper of 30 days or a bank loans of 30 days. This approach is known as matching approach or hedging approach. Working capital finance techniques. Using the long-term funds for short-term asset is expensive as the fund will not be used for the full period. Using short-term financing for long-term asset is costly as well as inconvenient as it needs continuous refunding arrangements. Firm follows matching approach use long-term finance for fixed asset and permanent current asset. The short-term financing for seasonal or variable current asset. However, exact matching is not possible because of uncertainty of the expected life of assets. So income it is the second approach, conservative approach. As I told you in the previous discussions, working capitals, there are three approaches: matching approach, conservative approach, and the second approach, that are the so-called conservative approach. If the firm depends more on long-term financing, the firm is said to follow conservative approach. This is the conservative approach is more maintaining or depending on long-term financing rather than short-term financing. Under this approach, the firm finances its permanent asset and part of seasonal asset with the long-term financing sources. At the period when seasonal current asset is not needed, the long-term fund can be invested in marketable equity securities. The most conservative approach will be to finance all the project funds requirement with long-term financing sources and use short-term financing sources in the event of emergencies or unexpected outflow of funds. It is unwise and hard to implement. This approach has some short-term financing sources are unavoidable. The others or the last approach in working capital, that are the so-called aggressive approach. It uses more short-term financing than matching approach. It requires financing seasonal current asset and part of the permanent current asset with short-term financing sources, and the part of permanent current asset and fixed asset with long-term financing sources. Some extremely aggressive firms may even finance part of their fixed asset with short-term financing source. So when counted is the risk return trade-off. As I told you, what is risk? Risk is refers to uncertain outcome. Focusing more on short-term financing has cost advantage and allow flexibility in financing. Focus more on long-term financing is costly, but less risky than short-term financing options. Therefore, aggressive approach is more risky than conservative approach. A short-term financing is less costly. This approach results in better returns than long-term financing. Therefore, aggressive approach is more profitable than conservative approach. Working capital management. What is working capital management? Working capital management is refers to an act of planning, organizing, and controlling the components of working capital like cash, bank balance, marketability securities, inventories, receivables, and all. So, what is the inventory management? Inventory management. Inventory constitutes the most significant parts of the current asset of the business concerns. So, a proper planning and controlling of purchasing, handling, storing, and recording of material should be considered as a part of inventory management. So, inventory management considers what to purchase, how to much to purchase, from where to purchase, where to store, and when to use for the productions and sales. The objective of inventory management. What is the objective of inventory management? The major objective of the inventory management as follows: to efficient and smooth production process, the raw materials inventory, to maintain optimum inventory, to benefit from available demand, merchandise inventory, to take the advantage of price fluctuations, speculative purpose, to guard against the risk of unpredictable change in demand, supply. Techniques of inventory management. So in quantity, the techniques of the inventory management. The first one is the economic order of quantities. EOQ is refers to economic order quantity. So suppose ordering cost per orders, O is a constant. The total ordering cost can be get the number of orders multiplied order cost per orders. The number of orders also can be determined by using of total annual requirement divided by the order size. TOC is refers to total order cost. A is refers to the total requirements. Q is order size. So this was about in today's lesson. Thank you very much.